For years, the housing market has been soaring to unprecedented heights, but whispers of a potential downturn are growing louder. What factors are driving this uncertainty? Is it just a hiccup, or are we facing a major shift? Our experts have been crunching the data, analyzing trends, and consulting with industry insiders to bring you the most comprehensive insights. Get ready for an eye-opening journey as we explore the surging rise and looming shadows. The housing market, once a steadfast pillar of stability, has morphed into an arena of staggering highs. Home prices reached levels that few could have foreseen, leaving many to marvel at the speed of this ascent. According to recent reports, average home prices across the nation increased by a staggering 17% over the past year alone. But beneath the dazzling surface, shadows have begun to stir. Economic indicators that once held steady are now wavering. The ground beneath our real estate aspirations might be quivering, and it's time we investigate the forces at play. A perfect storm, catalyst of uncertainty. Unraveling the enigma of this potential downturn requires delving into the intricate tapestry of influences. The jigsaw position of historically low interest rates and frenzied buyer demand has propelled the market upwards. However, data shows that the 30-year fixed mortgage rate has begun to creep upwards, with an increase of 1.2% over the past year, signaling that the era of ultra-cheap borrowing might be waning. But there's another player in this narrative, the rise of remote work. As businesses adapted to the pandemic, the commercial real estate landscape shifted dramatically. Offices stood vacant, casting uncertainty upon city centers and suburbs alike. The ripple effects of this remote work revolution are yet to be fully understood, and they're casting a long shadow over the real estate market's future. From euphoria to apprehension, red flags and indicators. Key indicators are often the whispers of change before it arrives with full force. As we scrutinize these indicators, the picture becomes clearer. An uptick in foreclosure rates, a subtle cooling of bidding wars, and the emergence of previously unseen buyer contingencies. All of these are warning signs. They signal a market recalibration that could either be a mere hiccup or a harbinger of something more profound. Impact unveiled. Homeowners, investors, and the economy. As the landscape evolves, the ramifications will be felt far and wide. Homeowners who saw their equity skyrocket could find themselves in a precarious position. According to recent projections, a potential downturn could result in a 10 to 15% decrease in home values, significantly impacting the wealth stored in residential properties. Investors who reaped rewards might be re-evaluating their strategies, and the broader economy, intricately woven with the threads of the housing market, could sway in response. The winds of change are unpredictable, but they carry the potential to reshape fortunes and futures. Clashing perspectives, navigating the crossroads. As with any uncertain path, divergent viewpoints emerge. Some experts argue that the housing market's ascent is resilient and unyielding, that these shifts are mere hiccups on the road to continued prosperity. Others, however, see a more seismic shift on the horizon, one that could rewrite the rules of the game entirely. These clashing perspectives fuel the suspense, leaving us all on the precipice of an unknown fate. The multifaceted dilemma, unmasking additional threats. Beyond the surface ripples, deeper currents are converging to shape this uncertainty. Increasing interest rates have the potential to make borrowing more expensive, weighing heavily on aspiring homeowners and investors alike. Simultaneously, the specter of rising unemployment due to business closure looms, potentially dampening demand and unsettling the market. Economic echoes, inflation and financial markets. Inflation, the oft unseen antagonist, can erode the value of hard-earned investments. As the cost of maintaining a house rises, homeowners might face an uphill battle to preserve the value of their asset. The interconnected nature of our economy ensures that the housing market is not isolated from the ebb and flow of wider financial tides. A dip in the stock market or a slump in cryptocurrency prices could reverberate, causing wealth to dissipate like morning mist. Credit crunch, the weight of credit scores. Even the seemingly unrelated has its role to play. The hypothetical downgrade of credit scores, a once unlikely scenario, could become a reality. This unanticipated shift could tighten the already constricting ropes around borrowers, making it costlier and more challenging to secure loans, a factor that could drastically impact market dynamics. Your wealth, your home, the high-stakes reality. For many, their wealth is inextricably tied to the home they've cherished, a testament to hard work and dreams realized. The equity amassed, the appreciation accumulated, it's a lifeline that transcends financial figures. But what happens if that cornerstone falters? Exploring this emotional resonance adds depth to the economic narrative, reminding us that these discussions are not detached from the heartstrings of our lives.